He asked me, Jeremy, this all sounds great, but what's the worst thing that could happen? And you know what I told him? I says, I'm going to lose all of your money. Truth be told, most of the deals that we've bought in the last 24 months, there has been a near or 100% wipeout of all common equity in those deals. Let's not talk about the cherry pick deals that are a part of your track record, but let's talk about those deals that you purchased in 21 and 22. Limited partners need to understand, like, you're an owner. You're an owner in this deal. We are tied and tethered together till death do us part.
Investors and operators, welcome back to the Invest Clearly podcast. I'm the CEO of Invest Clearly, Pat Zingarella. In today's episode, my partner Joe Guidi and Chief Strategy Officer of Invest Clearly sits down with Jeremy Dyer, the VP of Capital Formation of Rise 48 Equity. Jeremy shares how his experience as an LP shaped his approach as a sponsor and how he's adapted to LP sentiment around capital calls, pref equities in today's market. We also discuss his views on communication, team structure, and the long-term risk trade-offs in vertically integrated models. Let's get into it. The views expressed in this podcast are those of the individual guests and do not reflect the opinions or recommendations of Invest Clearly. This podcast is for informational purposes only and should not be considered investment advice. The appearance of a sponsor or investor on this show does not constitute an endorsement or a warning. Invest Clearly is an objective and neutral platform. Always do your own due diligence before making any investment decisions.
Jeremy, thanks for joining me today.
Yeah, Joe, it's great. It's a pleasure. Look forward to chopping it up with you today.
Yeah, really excited to talk about building investor trust with you. I know you've been in the game both as an LP and now on the GP side for a while. But for listeners who don't know you well, can you share a little bit about your background in passive investing and what led you to your most recent incarnation of that, Rise 48?
Yeah, I'd be happy to. So I've really been a technology sales guy for the last 2.5 decades, believe it or not. Very blessed in that space to really have come right out of college, hit the ground running, was the number one guy in all of North America. Nice. That all enabled me to be completely financially free by, get this, the age of 24, okay? 24, I was financially debt free, really. And that really enabled my wife and I to be in a position where we wanted to diversify outside of Wall Street and we wanted to diversify into Main Street. The question is were we going to, scratch the entrepreneurial itch, start a business? Were we going to invest in real estate, on the active side? We decided to deploy capital into single family home fix and flips back in 2012 because that seemed super sexy on HGTV, right? So that's kind of how we cut our teeth in the real estate space, is really through the fix and flip model. And that model was going well for us, Joe. The challenge is in 2015, my wife and I decided to double down on children. So we went from 2 kids to 4 kids. If you're reading between the lines, number 3 and 4 are twins. Yeah. And it really just became a bandwidth challenge for us. So, while I was continuing to crush the commission checks and the bonus checks, I also had 4 children, 2 of which were, beginning to get actively involved in sports and wanted dad to coach their teams. And I just, quite frankly, I had no more bandwidth to be able to spend my evenings and my, coveted weekends, dealing, with tenants and renovating properties, swinging hammers, and,
sure,
dealing with all the aftermath associated with, fix and flip as a strategy. So in 2015, we decided to go passive. Okay. I never really knew what the word syndication meant back in 2015, other than I know that the Green Bay Packers were a syndicated football team. Of course, now my perspective has completely changed, but 2015, we got our passive limited partner journey started. We really held our breath. We plugged our nose. That was kind of the strategy that we used. I just knew one thing, and that is I knew and I liked and I trusted the main operator. And so we deployed capital into our first deal, back in 2015. Now, if you fast forward till today, so 10 years later, my wife and I are actively in 40 deals right now as limited partner investors. I've invested with a dozen different operators and a half a dozen different asset classes. I've had deals that have been absolute and utter home runs, and I've had deals where I've lost 100% of my money. Okay.
Right.
So I've had that full spectrum, that full experience, having been a limited partner investor now for over a decade. A couple of years ago, I started letting my family and friends know about what I was up to, those that are part of my personal and professional network. And lo and behold, there was an enormous appetite out there for other people just like myself, a higher net worth individual, technology sales, that type of role, where they wanted to get involved as well. And so I started a capital raising private equity company. In 2 years, I was able to raise over $50 million from my personal and professional network, largely doing it part-time. That gave me a lot of credibility, of course, in the space. And a lot of eyes were on me, of course, during that time with the success that I had. And so it really caught the attention of Rise 48, where I am now. So I'm now the VP of Capital Formation at Rise 48. I've since retired from the technology sales job, and I still manage Starting Point Capital, but it's primarily a vehicle that we also use to raise capital into Rise 48 projects.
Got it. So just as you've transitioned, what is your day-to-day focus right now? Your capital formation, but tell everyone what that means just for those who don't actually know.
Yeah, totally. So we source capital from all kinds of different places. It could be anything from co-GPs to fund-to-funds managers or capital partners. It could be independent RIAs. It could be broker-dealers. It could be wealth managers, family offices. So really my role within Rise 48 is to source the capital from those partners, build relationships with them. As it relates to the fund-to-funds community or fund manager community, they really see me as being a coach, a mentor, somebody that's, kind of been there, done that, somebody that's had some success. They typically will reach out to me if they need a shoulder to cry on or if they need some pixie dust, right? So my job is really just to kind of help them, continue to motivate them, help them to continue to put in the necessary reps that it takes to continue to nurture, foster, and build their own individual networks so that they can become, capital raisers, that are not raising, 6 figures, but rather they're now in the 7-figure range. And once they get there, what can we do to help support them to get to that multiple, 7-figure range and beyond?
Got it. Yeah, that makes sense. So I guess what I want to talk about today a little bit is, obviously you've got an incredible journey. You've kind of made this transition, at Invest Clearly. We think trust and transparency on the sponsor side, building trust and transparency on the sponsor side, more important than ever in terms of like the capital raising motion. Like LPs, there's lots of options out there, as you've seen. It's not just capital raisers, like the number of GPs has proliferated, but also the way LPs are getting introduced to GPs is different. It's not necessarily long relationship building cycles as much anymore, though that does happen kind of as the relationship builds. But I want to talk to you a little bit about how you've seen that trust journey evolve and where it plays a role for you right now in kind of your investor education process.
Yeah, you did a really good job asking a question that I could talk about for the next 45 minutes. So I'll try to condense it down as much, and please keep me honest, of course, Joe, right? So one of the things for me as an individual, contributor, in this space is I oftentimes will remind investors that there's no such thing as a risk-free investment, right?
Sure.
There's operational risk, there's execution risk, which we can certainly dive into those topics. But I tell my capital raising community, my fund manager community all the time that my largest investor, the first conversation that I had with him, he asked me after, we had gone through the presentation deck, we had talked about, the investment and the benefits of passive investing in real estate, with this particular opportunity. He asked me, Jeremy, this all sounds great, but what's the worst thing that could happen? And you know what I told him? I says, I'm going to lose all of your money. Okay. And you know what he told me after that? He says, Jeremy, I'm going to invest in your deal because you had that level, of transparency. And I think it's just important for people to understand, like, investors will invest if they know, like, and trust you. But this type of an environment that we're in now is a little bit different. Okay. I believe that trust is built by being authentic, by being genuine, and by being transparent, right? There are investors that have invested as limited partner investors in the world of real estate syndications that have had some troubling time, okay? They've either had suspended distributions on deals, they've had capital calls, their common equity has been pushed down in the capital stack, they've lost investor capital. I mean, truth be told, most of the deals that we've bought in the last 24 months, there has been a near or 100% wipeout of all common equity in those deals. Those are the deals we're buying right now, okay? Because those are honestly the only types of deals that pencil. But I do think it's important that, the community as a whole really leans into the challenges. Okay. I know a lot of operators in the space, fund managers in the space that really are walking around right now with their tail between their legs. Okay.
Sure.
But those that are out there in front, publicly talking about the challenges of the current market that we're in right now, that it is not a seller's market, it is a buyer's market. We're buying right now. We're not selling, because why would we want to give the next buyer a discount? We're publicly out in front of our investors as well as our extensive network saying, listen, we didn't ask for this, point in time to happen. We didn't underwrite in our business model the historic run up in interest rates, We didn't underwrite in our business model that property taxes and insurance would skyrocket, We didn't underwrite in our business model that new supply would hit the market 24 to 36 months, after the point in which we took over the acquisition. We didn't underwrite all of those factors or scenarios into our original underwriting model. But what did we do, when we recognized the glut of new supply, when we recognized the impact of skyrocketing interest rates, when we recognized the increased costs of property taxes and insurance, right? What did we do in our underwriting model from that point moving forward? And second to that, of course, is, what are we doing to support those assets that were acquired during this 14-month period that every operator in the space is having challenges with right now? And that is that period from June of 21 through July of 22. It's literally that 14-month period. If you bought a property with 3-year floating rate bridge loan, during that 14-month period, you have distress right now. And it's really how are operators choosing to respond, to those investors, and are they staying committed to a successful or partial successful outcome, of that business plan for those properties acquired during that 14-month period.
Sure. So let's talk about that for a second, because like you said, you didn't underwrite those things. They weren't necessarily predictable, right? Historic run-ups in interest rates, as you said, like insurance costs, the whole deal, right? Things change, the market changes. So naturally, you're going back and having to revise projections, and then other things change in your business model. Like for instance, obviously at one point where I said we'll never have a need to do a capital call, right? And obviously the dynamics have changed a little bit, whether it's pref equity or capital calls, or at least the perception of that. I'm sure that's something that comes up. Like, how do you address that? Like, when you publicly make a statement, or the business publicly makes a statement, then you have to adjust course. That creates a lot of, what's the turbulence, I guess, in kind of like the investor trust mechanism. Walk me through how you've been navigating that.
Yeah. And if you think about it, like any operator that raised capital on a deal that had forward-looking statements in their presentation deck, right, they've had to pivot and they've had to adjust, right? So it was true up to a certain point that Rise 48 had not had a capital call. Well, why we were the last ones to have a capital call is because of the strength of Rise 48 and our ability to continue to support those assets with our own working capital, We tried to outlast the market, We wanted to protect and preserve investor capital. Their capital is number one. It sits in priority to our own invested capital, and we were willing to support those assets as long as it took. But quite frankly, we couldn't outlast the market, and we just simply ran out of time, right? If you go back to Q4 of last year, Q4 of 2024, all right, you had the Federal Reserve Bank lowering the Fed funds rate or the SOFR rate, but the 10-year Treasury responding in the opposite direction, So that, of course, is the major benchmark that's used when it comes to where interest rates all are. And you also had a time where the Federal Reserve Bank was continuing to suggest that there were further interest rate cuts coming. And that, of course, did not happen, right? And so most operators in the space were suggesting or shouting, survive till 25, right? Well, then 25 got here and we're still stuck, right?
I think it became survive through 25 after that. I'm not sure. I think it shifted. Yeah, slightly.
That's right. So, our plan was never to do a capital call. Even in Q4 of 2024, our plan was not to have to go to investors with a request for additional liquidity. But
Right.
it is what it is. We couldn't outlast the market. Obviously the supply demand constraints, absorption constraints, the higher for longer interest rate, environment. We had to solve for these assets, right? And so we chose to solve for these assets by asking for investors to continue to partner with us, on the opportunities.
Got it. Cool. What do you think is the most kind of like important thing for you to get through when you're explaining the strategic shifts to investors, though? Because I think that that's like, again, they don't always understand it, right? Not everyone's in 40 deals. Many of your investors, I'm sure they're in one or two or three deals. So they don't necessarily have a lot of experience with deals going sideways, or they've been doing it long enough to see market shifts. Like, how do you, as the person who's kind of like chiefly responsible for communicating with LPs, like communicate that to them effectively? And what are you trying to get across?
Yeah, it's a great question. I mean, really at the end of the day, I mean, you have to be human, right? You have to, be sympathetic, apologetic. We didn't ask for this. They didn't ask for, this type of an outcome, with their investment. They're just, and leveling up with people to let them know there are market cycles in real estate, right? Back in 2021, everybody was making easy money, and then that story stopped. I mean, there's operators in the space back in 2021 that were, buying and syndicating an apartment building, forcing zero NOI growth and just watching cap rates compress. And they looked like, they knew what they were doing when really they didn't, right? And so there was a lot of easy money to be had, back in 2021. That music, of course, stopped with the, glut of new supply, interest rates, additional, costs right at the property level that weren't, budgeted for or planned for, in the underwriting model. And the question then is, well, now that we are where we are, what is Rise 48 and what are other sponsors for that matter, doing to continue to support those assets? Unfortunately, some have just simply chosen to walk away and hand the keys over to the bank, right? Some have chosen to basically say, hey, this is a 40% rescue capital call. If you don't participate, you're going to get, crammed down and diluted. And there are other operators in the space, Rise 48, chiefly, that provide incentives to our investors to continue to partner with us, because limited partners need to understand, like, you're an owner. Okay.
Right.
You're an owner in this deal, right? We are tied and tethered together till death do us part. You don't have to be the one that's managing the business plan, but you're an owner investor. You're a partner with us in this property. And I think most investors, understand that on the front end. But for those that don't, we certainly want to educate them, that we really need your support and your help, right? And if we have to go to the market with a 20% capital call, what are we willing to do, right, to provide an incentive for those investors to continue to deploy, new capital in a way that they don't feel like they're throwing new money after bad, right?
Right.
And so the way that we've chosen to structure it, which I think, has worked out, most certainly in our favor, is we've chosen to structure it with a nice yield play, a nice current pay on new invested dollars. We've also allowed investors to have their original common promoted into the pref layer of the capital stack, right? Which, further assists with, further risk mitigation, on that investment. When possible, we'll even provide a corporate guarantee, on new money invested in those deals. So, we make sure that it's important that all investors understand that there's no such thing as a risk-free investment. It's really when things go south, who's the main operator that's behind that deal, and what types of decisions are they going to make in order to help support you and put you as an investor ahead of and in front of their own interests.
Right. 100%. And obviously you guys have taken your fair share of, like, probably gotten more coverage than most just because of the rise of Rise 48, for lack of a better term. I think one of the interesting things about you, Jeremy, is like you were an LP in Rise well before you started working there. So you're coming at it from a perspective, presumably some of your own invested dollars are in some of these deals that took place during that time, I would think, as an LP, correct?
Yeah, I mean, outside of the founders, I'm the largest investor in Rise 48, right? Outside of the main founders, I'm their largest single LP investor, in their deals, and have raised over $50 million into, their deals and opportunities. And as I, maybe mentioned before we started, recording, I'm also an LP investor in a lot of other operators deals that are in the space, many of which are, household names in this industry, and all of which, have distress on their current portfolio from deals that they purchased in 21 and 22.
Yeah, no, I think that's, again, like I said, what makes your perspective so interesting, because you're speaking this as the representative of the entity to the LPs, but you are the LP as well, right? You're kind of drinking your own medicine. You're able to relate to them and say, hey, this is what I would want to know if I were in your shoes. And by the way, I am in your shoes. So
Yep.
it's it probably not always easy to actually get that across, though. So I'm wondering, if you could walk me through a few scenarios, or they don't have to be too specific, obviously, but where like you've had to communicate something, or where you were in a trust building environment and you could actually communicate that effectively, and maybe one where it didn't go as well. If you want to share that, not as well one, you don't have to.
Yeah, I mean, for sure. And again, keep me honest, because I'm not entirely sure exactly what you're asking me as far as a question is there, Joe. But I have a competitive advantage in the space, of not only raising capital but also partnering, with fund managers and other institutional investors, because my lens is much further out, right? I have the luxury, of having had actual limited partner experience and exposure with a lot of different operators, right? Most operators don't have the level of view that I have, because they only invest in their own deals, right? Many limited partners, lack that as well, because they'll maybe get, they'll hook their trailer up to one operator's truck and never let go, right?
Sure.
Whereas I've had experience, investing with multiple operators over different asset classes, different market geographies, locations. And again, I've had deals that have been, grand slams, and I've had deals, I've lost 100% of my capital as well.
So maybe let me reframe the question then. Maybe you could talk to me about times when operators were trying to build trust with you, right? And when you saw it done really well, and when maybe something was happening in one of your investments and the operator didn't really address it the way that they should have.
Yeah, I mean, you're obviously drilling down on, transparency and performing, due diligence on the operator, right?
Well, it's a relationship business, Jeremy. I mean, like at the end of the day, when I always tell operators, it's like, hey, no matter how programmatic capital raising becomes, or no matter how much research investors do on their own, like at the end of the day, this is about a relationship between people that gets built. And so, there's a process there. We know that whether you're dating or investing, there's a process to building that relationship, and there's moments when trust is either built or degraded. So
you're spot on, right? I mean, at the end of the day, like raising capital for real estate or any investment, okay, whether that's your financial advisor or you raise, private equity, right? It's a sales job, okay, and it's predicated, that relationship is predicated on trust, right? You're building trust by having genuine, authentic, transparent conversations with other people. You're building into that relationship. You're serving others, right? You're finding a way to provide value to people. Everybody's got pain points. We need to uncover what those pain points are, right? And then provide a solution for those pain points. And so I have a lot of operators that reach out to me all the time asking for me to raise capital into the deals, right? Usually my response is I don't have enough bandwidth to be able to do that. I've got deal fatigue, that sort of thing, right? More than happy to have and entertain those conversations with them. In fact, I host my own podcast called The Freedom Point, and I've had hundreds of operators, on as guests, to talk about their own individual firms and,
Sure.
why it is that we as, limited partner investors, should consider deploying our capital with them, right? But you're exactly right. I mean, it's all 100% a relationship business. And I tell people all the time, like, listen, if the operator is not going to be fully transparent with you during the good times and the bad times over the course of that, business cycle hold time, or they're not willing to talk to you about deals that have not yet gone full cycle. Okay. I always tell LP investors, like, there are operators that selectively cherry pick deals to include in their track record. Okay. There are operators like Rise 48, for example, that they don't cherry pick. Their track record of 11 sold deals is not cherry picking. Okay. That is the 11 deals that have gone full cycle. But the question that most limited partner investors need to challenge the operator with is, let's not talk about the cherry picked deals that are a part of your track record, but let's talk about those deals that you purchased in 21 and 22. Let's unpack those deals, right? And equipping those LP investors with the types of questions that they can ask really does help them to understand, is this a transparent operator or do they have something to hide? And if they have something to hide, why are they trying to hide it, right? So I think that's all, incredibly important, and I would challenge, your listening audience to do that. But the other thing that I, challenge LP investors with all the time is, you can say that you're doing your due diligence, but the truth is that your due diligence is just reviewing the pitch deck. Okay. There's not a lot of due diligence in reviewing the pitch deck, right? Because the pitch deck is not worth the paper it's printed on, right?
Yeah,
the operator is not going to hit those projections. Okay. They're going to either exceed them or they're going to fall short, right? So really the only way, in my opinion, to do proper due diligence on an operator is, number one, invest in their deal. Okay. Invest in their deal. You're going to get to know about their transparency level, their monthly reporting, are they providing investors with access to the same financial information that they have to provide to the senior lender, who is arguably the largest investor in that deal anyways, right? Does the LP investor have access to things, not just like balance sheets and income statements, but the full general ledger, bank statements, right? Does the LP investor get access to that level, of transparent information? And if the answer is they don't, then I would run in the other direction. I would find a different operator to partner with. So I'm with you 100%, Joe. I think that the challenge out there right now is people are uneducated in the sense that they just don't know what questions to ask. You have that group of potential investors out there in the ecosystem. The other side is you have LP investors that invested in one or two deals at the peak of the market because everybody was making money. They got burned and they may never come back again, when really they should, because the same thing that happens in the commercial real estate space happens in Wall Street, right? I mean, how many of your buddies were telling you, I think I should, sell some stocks, when Trump announced the tariffs and the Dow and the NASDAQ fell 15%, right? I mean, I had those people too, right? They were trying to catch a falling knife. Well, the same thing is true in multifamily real estate and any commercial alternative asset. If you zoom the lens out far enough, okay, it's going to go up and to the right. But there are market cycles and there are mini market cycles within a major market cycle, right? And so my firm belief, right, is find and identify the best in class gold standard sponsors in the space that have thick ice beneath their feet, that are transparent and they can be trusted, right? And then your next strategy is to dollar cost average. Because I tell people all the time, I was investing in 2016. Okay. If you remember 2016 and 2017, everybody was screaming, a recession's coming, a recession's coming. Well, guess what never came? A recession. If you sat on the sidelines between 2016 and 2021, you as an investor, you missed out on a 5-year utter bull run in the commercial real estate space, right? Make sense?
Yeah, definitely. No, without a doubt. I mean, I think I want to just kind of double click on the point you just made, though. I do think that a risk in the space, and one of the things I hope like greater transparency and better tools solves, is the fact that like some LPs who came into the market and maybe have or feel burned, by operators who maybe aren't acting transparently or lost money and they're not ready to come back, or maybe will never come back, actually does significantly hamper the efforts of good operators who are trying to grow, because there's a lot of opportunity for LPs in the space, a lot of opportunity for GPs. We need to make sure that but through promoting trust and transparency, we can make people feel comfortable in investing in it. I want to make sure we kind of give you, as you look forward over the next year or 2 years, what do you think is most important about how Rise 48 shows up for its investors?
Yeah, I mean, obviously it's to continue to be, transparent with our existing investors, continue to attack the market at a time that we're down, right? I mean, we're acquiring assets, but, anywhere from 20 to 30% discounts. There's deals that we're buying right now that there's a total wipeout of all common equity in those deals, right?
Yeah.
So that we're heavily in attack mode. We're continuing to transact, deals and volume in the two major markets that we're currently focused on, one being Dallas, Fort Worth, the other one being North Carolina, specifically the markets of Charlotte, Greensboro, and the Triangle Park area of Raleigh, Durham, Chapel Hill. So we're not shying away from where we are right now in the current economic cycle. In fact, we're expanding, our base of employees. We now just exceeded 300 full-time W-2 full benefit employees. We're going to continue to remain vertically integrated, on the property management, building construction, building maintenance side. We brought HVAC in-house this year because of the huge margins that exist in the HVAC industry. And when you have, regulations changing the ingredients within, Freon, that causes the cost of AC units to go up 20 to 30%. And when you're an operator in the sunshine states, very hot states, and you own 11,000 doors right now, that's a huge profit center for us. We have a lot of our lenders, that are actually hiring and coming to Rise to manage their properties on behalf of them with deals that they currently have in foreclosure right now. We have around 1,000 doors that Rise Residential does not own. We do not own those assets. We're just managing them on behalf of some of our largest senior lender relationships. So we're going to continue to, stay laser focused, on our boring buy box strategy of buying, B plus class properties with 30 to 40 year, vintage, where we can implement our boring strategy of renovating units, forcing NOI growth. And of course, we're still projecting a 2 to 5 year hold period on the assets that we're purchasing right now. If there's an opportunity to sell or refinance a deal in 2 or 3 years, we're certainly going to take that profit off the table and give that back to our investors. But we're also prepared, to continue to weather the storm. But we feel very confident in the markets that we're in right now. We're already starting to see concessions starting to burn off. We're starting to see, kind of a shift in the supply absorption or supply demand, dynamics in those markets. And of course, nobody's got a crystal ball as it relates to things like, inflation and interest rates, but it seems like, the 10-year treasury has been, bouncing around about a 50, basis point, spread, for the last, 12 months. So, that's obviously anybody's guess there in terms of what's going to happen. But, we're very optimistic and bullish, especially about the deals that we've been transacting, since September of 22 until today.
Got it. Yeah, no, that makes sense. So what would you say in terms of people who are thinking about investing with you or have invested you, what should they expect from you and your team in terms of communication?
Yeah, but we communicate with our investors every month. So investors get a monthly update, from, our transactions team and our asset management team. We provide a full write-up in terms of, the month over month, what, how many units have been renovated, where we've been able to achieve or not achieve, pro forma, rent growth increases. Like I mentioned before, we give, very detailed information to investors so they always understand exactly where we're at, during the execution of the business plan, providing them the same level of detail that we're required to give to the senior lender every month. And then of course, our team is always ready and available. I have 4 people that make up our investor relations team. Now we just hired a 4th person, on that team. I've got 3 individuals that make up our capital formation team. So between myself and the team, we've got, 8 individuals, plus Zach, Captain Stahl, and Bikram Sandhu and Rob, they're by all means willing to get on the phone, and talk to investors as well. We're just a transparent shop, right? We've got nothing to hide here. And we hope and understand that, some investors have gone through a troublesome time, in real estate, and the ice beneath the Rise's feet is very thick. And, we look forward to, partnering with folks onward and into the future.
Awesome. Well, this has been great. I really appreciate your time. In closing, just if someone wants to learn more about your approach or get in touch, where should they go?
Yeah, absolutely. Thanks for asking. So you can certainly head over to our website, rise48equity.com. You're also welcome to reach out to me directly at jeremy@rise48equity.com.
Awesome. Thanks, Jeremy. Really appreciate it.
Thanks for having me, Joe.
Thanks for listening to the Invest Clearly podcast. To find verified investor reviews, or to claim your GP profile, please visit investclearly.com. If you enjoyed this episode, please remember to like, subscribe, and leave a review because that's how other people find the show. Till next time, invest clearly.